Howdy, Jacob here. Today we're looking at Sinclair, ticker symbol SBGI. It is in the media industry, $902 million market cap with a $4.4 billion enterprise value. A lot of net debt on this company. It's a media company that focuses on providing content on local television stations and digital platforms. The company distributes its content through broadcast platforms and third-party platforms. Okay. So revenue side, 1.4 billion in 2013, all the way up to 3.9 billion in 2022 after a massive decline in 2021 of 36%. Return on invested capital outside of 2022 is relatively mediocre in the mid single digits. So nothing too impressive there for reinvestment back into business. Free cash flow, I mean, they are a cash cow. They are producing a lot of cash, but the use of cash is interesting. And so we see this huge acquisition in 2019, which introduced $8.7 billion in debt alone, which is more than what they have. I mean, right now they just have $4 billion in long-term debt. So they introduced a whole crazy amount of debt there, and then I don't really see a sell-off of business and not too much dividend payback. So I don't know how they went from 12 billion down to 4, because I don't see where they paid that off or sold something. But their use of cash flow outside of that big acquisition year is tiny bit on acquisitions, a little bit on investments, a little bit on dividends. Most recently, actually, a little bit of debt payback, so that's been nice, and then a lot of share buybacks. Okay, so what's the payout ratio? Looks very low. We see 70 million in aggregate. I'm looking at the right row, right? Yeah, 70 million in aggregate for cash paid for dividends, and on a 5-year average, probably 500 million in free cash flow. So that's less than 20%. They focus a lot on common stock buyback, so 160 million aggregate in rolling 12 months with a 500 million payout. Still, that's 30 to 35% payout there, and then again a little bit on acquisition, a little bit on investment back into the business. So interesting from that perspective. Balance sheet's interesting. They have 884 million cash equivalents, 38 short-term debt, 4.2 billion in long-term debt. And they do have a lot of long-term debt. And I guess, like I said, their 5-year average maybe was like 500 million, so that's 8 times. But if they wanted to, with just a 69 million, like 70 million dividend payout in aggregate, and their yield is 6.9%. I mean, they could just keep that and then focus the rest, like maybe that's whatever that is, 15% focused on dividend. You could say 15% on stock buybacks, 15% on acquisition, 15% on investment, and then that remaining 40% all going towards paying down that debt, which, I mean, that payout ratio sounds pretty close to what they did in 2021 and 2022. And so I think it's reasonable. It's just that difference in market cap and enterprise value is baffling me. Because if their 5-year average free cash flow is $500 million, then their price to cash flow would be less than 2. Oh man, that's confusing business. All right, so I mean, to me, that dividend payout, I think they can afford it, so I'm gonna keep it the same. But I want the company to start focusing on paying down debt. I can already feel like this is going to look like a screaming buy. So let's do I mean, outside of last year, they've literally grown every single year. So let's say 0%, 10 on the PE, price to free cash flow, 15 discount rate, margins maybe 10, 15. Um, let me think about this. So if their debt increased 2%, we're looking at about, on 4 billion, we're looking at about 80 million. 80 million in relation to 500 million is less than 20%. And this is very volatile. So I'll focus on free cash flow. So yeah, I mean it's a hit to their margins, but not as bad as one might think. So let me just bring that down, and then they've been buying back shares like crazy. Okay, well, this will be an interesting company to look further into. I feel like because right now it says it's the deal of all deals, and so I'll do a further analysis on the stock hopefully in the next week or two. Because I mean, from an initial standpoint, I understand that the market cap is so much lower than their enterprise value, and so there might be a reason to change these assumptions. Maybe when I dig further into it, they're going into less margin businesses. And I mean, their margins have gone down over a 10-year period. So gross margin was 62 down to 49, and then operating margin 24 down to 14. But even if I bring those down, a couple percent to 8 and 10, we're still looking like it's a screaming deal. So yeah, I'll have to do a deeper dive here. But until then, have a good rest of your day. Thank you.